Welcome to Scratch the Brain. Today, we are unraveling a concept that affects every single person on the planet. Inflation. Simply put, it is the rate at which the general level of prices for goods and services is rising. Think of inflation as a reduction in the purchasing power of your money. This means that a single unit of currency buys fewer goods and services than it did in the past. One of the primary drivers of inflation is the money supply. When central banks print more money, there is more currency circulating in the economy. If the supply of money grows faster than the production of goods, each individual dollar becomes less scarce and therefore less valuable. It is the law of supply and demand applied to money itself. Now, let's talk about demand pull inflation. This happens when the demand for goods and services exceeds the economy's ability to produce them. Imagine a popular new smartphone. If everyone wants one, but the factory only makes a few, the seller can raise the price because people are willing to pay more to get it. The opposite side of this is cost push inflation. This occurs when the costs of production increase for companies, forcing them to pass those costs on to consumers. A classic example is a spike in oil prices. Since almost everything needs to be transported, higher fuel costs make groceries, clothes, and electronics more expensive to deliver. Wage increases can also lead to inflation. When workers demand higher pay to keep up with living costs, businesses raise prices to cover the higher payroll, creating a loop. To track inflation, economists use the Consumer Price Index, or CPI. This measures the average change over time in the prices paid by consumers for a basket of goods. This basket includes essentials like housing, food, transportation, and medical care. If the total cost of the basket goes up, inflation is happening. So how does this impact you? The most immediate effect is on your savings. If your bank account pays 1% interest, but inflation is at 5%, you are technically losing money. Inflation also affects loans. Interestingly, it can benefit borrowers. If you have a fixed-rate mortgage, you are paying back the loan with cheaper dollars over time. However, for those on fixed incomes, like retirees, inflation can be devastating. Their monthly check stays the same, while the cost of bread and medicine continues to climb. Central banks, like the Federal Reserve, try to manage inflation by adjusting interest rates. When inflation is too high, they raise rates to cool down the economy. Higher interest rates make borrowing more expensive for businesses and consumers. This reduces spending, which eventually slows down the rate of price increases. Is some inflation good? Most economists believe a small, predictable amount, around 2%, is healthy. It encourages people to spend and invest rather than hoarding cash. But when inflation spirals out of control, we call it hyperinflation. This is when prices rise so fast that the currency becomes nearly worthless within days or even hours. Understanding inflation helps you make better financial decisions, from how you invest to how you budget for your daily needs. Thanks for watching. If you found this explanation helpful, please hit the like button and subscribe for more deep dives into the world around us. See you in the next video.
Like, share, comment, subscribe, and hit the bell icon.